In early 2024, e.l.f. Beauty looked almost unstoppable. This was not some sleepy cosmetics company. e.l.f. had become one of the hottest growth stories in the entire beauty industry. The company understood younger shoppers. Its products were affordable. Its marketing constantly showed up on TikTok and social media. New products could go viral almost overnight, and Wall Street loved it. The stock climbed all the way to about $221.83. Then something changed. The stock started falling and falling. Eventually, e.l.f. traded nearly 78% below its peak. That sounds like the business collapsed, but it didn't. Fiscal 2025 sales still increased 28% to about $1.31 billion. Fiscal 2026 sales increased another 25% to roughly $1.64 billion. So why would investors punish a company that was still growing? Because the real story was not that e.l.f. suddenly became a bad company. The problem was that the business investors thought they owned started looking very different. And there were 5 major reasons. Reason 1, Wall Street expected perfection. Start with the stock price itself. e.l.f. had delivered incredible growth. At one point, quarterly sales were growing more than 70%. When a company grows that quickly, investors begin imagining years of the same thing. That is where things get dangerous. The stock starts pricing in the future before the future actually arrives. So e.l.f. did not simply have to grow. It had to keep surprising Wall Street. When management entered fiscal 2025 expecting sales growth of roughly 20% to 22%, that was still excellent growth for a cosmetics company. But compared with the 71% growth investors had just seen, it suddenly felt slow. This is called valuation compression. Nothing has to go terribly wrong. Investors simply stop paying an enormous price for every dollar of future profit. But valuation was only the beginning. There were real problems developing inside the business too. Reason 2, the product machine started to miss. This may be one of the most important parts of the story. Part of e.l.f.'s success came from its ability to constantly create products people wanted to talk about. A product launches, TikTok starts talking about it. Customers rush into stores. Retailers give e.l.f. more shelf space. Then e.l.f. launches the next hit. It became a powerful cycle. But that strategy has one weakness. You need to keep producing hits. By early 2025, that machine was not working quite as perfectly. Management admitted that a couple of its new spring products were selling more slowly than expected. At the same time, the company was comparing against the previous year's huge launch of Glow Reviver Lip Oil, one of its biggest viral successes. Beauty category demand also weakened. In January, management saw softer than expected consumption and eventually cut its annual sales and profit forecast. That mattered, because investors started asking a very uncomfortable question. Was e.l.f.'s incredible growth repeatable? Or had some of that growth come from a period when almost everything it launched seemed to work? There is nothing wrong with having viral products. The problem comes when Wall Street begins expecting every product to go viral. Reason 3, its low price strategy collided with China. Then came a much bigger strategic problem. One of e.l.f.'s greatest competitive advantages was price. The company built its brand around making trendy beauty products available at much lower prices than many traditional brands. That is a powerful message. But behind those low prices was an important part of the business model: China. A very large share of e.l.f.'s products were manufactured there. That helped keep manufacturing costs low. Then tariffs changed the math. Tariffs increased the cost of importing those products into the United States, and e.l.f. reported significant tariff exposure. In the June 2025 quarter, gross margin dropped about 215 basis points, primarily because of tariffs. Now management had a difficult choice: raise prices. That could weaken e.l.f.'s value advantage. Keep prices low? Then e.l.f. absorbs more of the tariff, and margins suffer. Move production? That takes time and money. This is a genuine business strategy problem. e.l.f. had built an extremely successful combination: trend-driven products plus very low prices. But the supply chain supporting those low prices suddenly became more expensive. The strategy had not completely failed, but one of its biggest strengths had turned into a vulnerability. Reason 4. Sales grew faster than profits. Then investors noticed something else. e.l.f. was getting bigger, but getting bigger was also becoming expensive. The company kept spending heavily on marketing, digital campaigns, store displays, distribution, employees, and infrastructure. Those investments can make sense. But eventually Wall Street asks, where is the operating leverage? Operating leverage sounds complicated. It really means something simple. If sales rise 20%, investors would eventually like profits to rise even faster because many company costs are already covered. But e.l.f. started showing the opposite problem. In fiscal 2026, sales increased 25%. Adjusted EBITDA increased only 13%. And in the March 2026 quarter, sales jumped 35%, yet adjusted EBITDA fell 28%, while adjusted EPS dropped to 32 cents. SG&A expenses had risen sharply as marketing, merchandising, distribution, and other investments increased. That does not mean the spending was wasted. But investors were no longer seeing the beautiful equation they wanted: more sales equals much more profit. Instead, they saw more sales, more marketing, more infrastructure, more tariffs, more expenses. That makes the growth story less valuable. Reason 5. e.l.f. started buying its next growth engine, and then the strategy became even more interesting. Instead of relying only on e.l.f. Cosmetics, the company started building a portfolio. In 2023, it bought Naturium for about $355 million. Then came a much bigger move. e.l.f. agreed to acquire Hailey Bieber's Rhode in a deal worth up to $1 billion. The company paid $800 million at closing, including $600 million of cash financed with debt. Plus, there was another potential $200 million earnout. Rhode may turn out to be a fantastic acquisition. In fact, its recent performance has been extremely strong. But think about how the investment story changed. Before, Wall Street was buying. e.l.f. creates cheap products, makes them go viral, and takes market share. Very simple. Now investors had to think about Rhode, Naturium, integration, debt, interest expense, international expansion, different price points, different customers, and whether management had paid too much. Long-term debt climbed above $800 million by December 2025 versus roughly $154 million 1 year earlier. So the company may have created another growth engine, but it also increased the amount of execution risk. So is e.l.f. actually broken? This is where the story gets interesting, because the answer right now looks like probably not. The latest results actually show meaningful improvement. In its newest quarter, e.l.f. Beauty reported sales of about $479 million, up 36%. Management also raised its fiscal 2027 sales forecast to approximately $1.94 billion to $1.97 billion. Rhode has been a major contributor. International markets are expanding, and management says its value strategy continues to attract customers. So Wall Street is beginning to get some evidence that the business can recover. But 3 questions still matter. First, can core e.l.f. grow again? This may be the biggest one. Investors do not want Rhode hiding weakness inside the original brand. They want e.l.f. Cosmetics itself producing strong product launches, gaining shelf space, and increasing unit sales. A successful Rhode does not completely solve a slowing e.l.f. Wall Street needs both. Second, can Rhode justify the price? The early results are promising. Now management needs to prove that Rhode can grow through Sephora, international expansion, and new categories without losing what made the brand special. If that happens, Wall Street may stop looking at the acquisition as a $1 billion risk. It could start looking like one of e.l.f.'s smartest moves. Third, can profits finally catch up? This is the final test. Revenue growth is exciting. Market share growth is exciting. Viral products are exciting. But eventually shareholders need earnings and cash flow. Wall Street wants to see tariffs controlled, gross margins stabilize, expenses become more efficient, and profits grow faster than revenue. That would show the business has operating leverage again. The bottom line, e.l.f. Beauty did not fall nearly 78% because people suddenly stopped buying makeup. The real story was more complicated. The stock had been priced for perfection. Growth slowed. Some new products did not hit as quickly as expected. A China-heavy supply chain collided with tariffs. Expenses rose faster than investors wanted. And management transformed a simple e.l.f. growth story into a much larger acquisition and portfolio strategy. That frightened Wall Street. But now the situation is starting to change. Rhode is growing. International expansion is working. Total company sales are accelerating again, and guidance is moving higher. The comeback, however, still needs proof. Core e.l.f. needs to strengthen. Rhode needs to justify the billion-dollar bet, and profits need to catch up with sales. If those three things happen, investors may eventually look back at the collapse and say, the market became too pessimistic. If they do not, the stock may have fallen for a very good reason. That is what makes e.l.f. Beauty interesting right now. The company has already proved it can create hype. Now it has to prove it can turn that hype into durable, profitable growth.